2018 has seen two major corrections, which is unusual but not unprecedented in financial markets. So as we look into the end of the year, looking at market history, you would generally expect a very strong rally into the year end, particularly after you've had an October correction. However, we would be less confident of that rally this year, although we would say there's an odds-on chance of a rally through into the year end. We see the possibility of markets continuing weak right into the year end as relatively high compared with normal circumstances. Negotiating the whole Brexit turmoil is one of the biggest challenges for us as mixed asset managers. We typically look at our portfolios and they're heavily invested overseas, so clearly all the Brexit turmoil is largely good for our portfolios. When sterling is weak, we benefit. So for us as mixed asset managers, we're more concerned about being underexposed to the UK if there is a favourable outcome to Brexit. So broadly, we've been increasing our sterling exposure, increasing our UK domestic exposure. The whole active-passive issue, we think, has been one of the key drivers of markets since the global financial crisis. Passives clearly benefit from the environment of very cheap money, the whole QE era we've seen, and very low interest rate environment. As we move out of that to higher interest rates, the absence of QE, clearly volatility will increase, and therefore the opportunity for stock pickers, for active managers, is clearly going to increase. So we think as markets become more challenging, the need for active managers is clearly much greater. UK equity markets have been very out of favour since 2016 and the Brexit vote. And so UK domestic stocks have been particularly hard hit during that process. We've also seen, a certain degree of weakness as consumers also have been less confident going into the whole Brexit turmoil, which has affected their mood and sentiment. Clarity on these issues, we believe, will lead to a significant bounce back in consumer spending. So consumer cyclical stocks, which are both cheap and have the possibility of increasing revenues, such as home builders, such as retailers and other consumer cyclicals, we see as a huge value area in the UK. Coming out of 2018, where we've seen broadly a slowdown in lead indicators, or less so a slowdown in actual growth, the expectation for 2019 is going to be for slower growth in 2019 there was in 2020, with some possibility as we exit 2019 and 2020 that we might be looking at recession, but we clearly do not know that right now. So our view going into 2019 is to be broadly neutrally positioned on economic growth. But the one thing we do believe is likely to be prevalent in 2019 is continued rising inflation. Whether the Fed gets too strong at pushing that inflation away is the big question. But rising inflation, so beneficiaries of inflation, will be our key themes of 2019. As we look into 2019, our key theme being inflation, there are two ways of really playing it. There's hard assets in the form of classic defensive companies such as roads or utilities or airports and so on and so forth. These businesses have inflation-linked revenue streams and therefore will benefit from rising inflation or defend your portfolios against the possibility of rising inflation. At the other side of the coin, if you're still confident of economic growth, again, hard asset businesses in the cyclical areas, such as oil pipelines, such as paper mills and so on and so forth, again, classic beneficiaries of inflationary markets. So we look to those two areas to build the core of our portfolio going forward in 2019.